people now and get stuck into stocks and share markets. Again, I'm Australian equities, less so international, but there is overlap, so we'll talk a bit about that. I'll give you a bit of an overview, followed by we'll talk about some themes. We'll then talk just one slide I want to share from an educational perspective about how we invest, and then we'll get into the portfolios and some stock updates as well. First presentation I did to clients was this time last year when I just got my feet under the desk, and what we were doing this time last year was getting towards the end of the year. We're usually in a pretty buoyant seasonal period, markets are doing well, so we were talking about the setup for 2025. We're 12 months on, so before I tell you about what we're thinking for 2026, let me just reflect on what we were saying this time last year and how we were characterising the outlook for 2025, and then I'll tell you what's happened. So this time last year, we were describing share markets as having performed very strongly thanks to a soft landing narrative, so cooling inflation, allowing central banks to lower rates, but not lowering rates because they're trying to defend growth or deal with contraction. So it was a Goldilocks environment. What that led to was an anticipation of these rates taking share prices higher. This is what John was talking about earlier. Markets don't wait to be told, they get ahead of the curve. So we were, this time last year, dealing with elevated valuations, and we were also dealing with limited yield, and that was very notable relative to bonds. As you know, 10-year Aussies are at 4.4%, the ASX dividend yield's at 3.3%. That's very unusual. So it was telling you valuation was elevated, telling you rate cuts are priced in, so therefore 2025 has to be about earnings. Let's seize the earnings leadership, take the baton from rating and deliver good returns in 2025. If that isn't going to happen, and we had our reservations, as you remember, about the ability for our market to grow, and we'll get into the details as to why, you should expect a more muted return than what we enjoyed in 2024, which was a strong year. So what happened? Well, this is the chart on the right describing, it's only updated to as of last week. Okay, we've got some wood to chop yet. I can't remember the number of days till the end of the year, but it is still illustrative, save for a collapse, which is unlikely. We can easily describe 2025 as another strong year. Markets all over the world have rallied strongly. We had a meltdown, as you remember, Liberation Day, tariffs, a big shock followed by Taco. Trump just backed away, and we had markets able to get back into a groove. Generally, for most of these markets, what they were doing was rising with earnings. The one exception was Australia. So Australia's this dark blue here. Australia has yield, different to other markets, but Australia has been a bit of a laggard. But all the same, I've been a little bit surprised by how strong our market's been, and I'll show you the reasons why. The reason why I've been a little bit surprised by the strength of the market has been we've had another year like 2024 when we had contribution from rating. So this is the multiple of the market going up again. And in a moment, I'll share what's driven that. On the left chart here, it's busy, but let's just simplify what you experience as a total shareholder return. You've got two sources. You're either getting income from your dividends, and there's a yield associated with that. They are the blue columns, okay? And dividends are positive, and you always get a dividend. And the dividend yield might be 3 or 4 or 5%. That's historically what you get. The rest is capital growth. And your capital growth is just how much your price is changing, and that's underpinned by one of two things. Either it's coming from the earnings or it's coming from the rating of the earnings, okay? So what surprised me this year was after a year like 2024, when you had minimal contribution from earnings in the green and a normal contribution from dividend in the blue, there was a large slab of the total return coming out of PE change. The market went from about 17.8 times to into the 18s. In 2025, we've had the same thing happen all over again. More rating, very little earnings. Earnings, as you can see, has been quite anemic in our market for a number of years now. And that's surprising when, as I said before, we already had this time last year an expectation of rate cuts and a lot of sectors at altitude. So it's been overall a bit of a stronger year. Excuse me, I'll just go back. Where has the rating increase come from then? Why did our market get a rating increase? Well, as busy as this is, hopefully I'll be able to simplify it for you just to compare the backdrop of Australia to the US market, okay? And the US market's very important to you. Again, I'm Aussies, not equities, Aussie equities, not international, but you will have money in the international market. You will have perhaps 70% of your money in the US, and you will have close to 40% of your money in these 7 stocks alone. But I've got good news. They're growing, okay? We'll go to a debate in a minute about their outlook, but they are growing, and that justifies why their prices are increasing. So the Mag 7 in 2024 had a very strong year, validated by earnings, and the same things happened again this year, okay? So there's been about a $3.6 trillion increase in the market cap of these 7 biggest stocks, and alongside, so that's a 20% increase from the start of this year, alongside an earnings increase of about 16%, okay? So roughly in line with each other, that's quality. What about Australia? We're the same type of market, believe it or not, we're a top-heavy market. So you've got roughly the top 10 stocks accounting for about 40% of the index, but the similarities end there. We don't have big dog stocks delivering much by way of growth. So if I just take an easy sample, let's go with the banks, okay? The banks this year have seen about a $100 billion increase in market cap, alongside an increase in the market cap of the total ASX 200 of around about 230 billion. This was calculated as of the 8th of November. In other words, banks have contributed about 50% of the increase in the value of the ASX, okay? Is that justified? Well, I would say to you it's not really justified when the earnings that's coming through has only been about 4%. So that's describing what's been the progression of earnings across all the banks from 12 months ago. It's about plus 4%. So 18% price, 4% earnings, that tells you the rating's gone up. So there's been a lot of concentration in this market, and that is part of why last year I was saying you shouldn't expect this to persist, because rating has limits. And therefore, where does it leave us? Here's another way to illustrate. I'm really trash talking the banks. Don't get me wrong, we've got lots of banks, but I want to put it into some perspective later on why you need to invest very carefully in an environment like this. We are running some sort of different race here in Australia in how we're rating the earnings of these banks, which is illustrated on this chart. This is just taking an average of the PEs of the 4 major banks, of which CBA is the biggest, but I've only taken an average. I haven't taken a market cap weighted average. We've moved out over 20 times. Here's a plot of peers from the US, including one UK bank, HSBC. It is not easy to describe to you why we've had this disconnect. Leo mentioned liquidity. There's lots to unpack there. But the point is, we have arrived at some sort of altitude where there's been a movement in price away from fundamentals that creates significant risk. Another way to illustrate why it's not justified is that's CBA's earnings worm over the last decade. Okay, so 10 billion of profit remains 10 billion of profit. The rest of these peers have all grown their earnings considerably. And if you then went to another metric, ROE, so ROE is about what returns you're getting on equity, and you measure that relative to your cost. The bigger the spread, the more you can create value. That's very lacking. None of our major banks produce ROEs any different to what you can observe from overseas peers. So it's very hard to, as a fundamental investor, be able to provide good reason as to why this is happening on the grounds of fundamentals. It's happening on the grounds of sentiment and liquidity. And we'll talk more about that. So I'd like to introduce a few themes. Themes, why do we do themes? Themes are just to help you understand what's on our mind, what comes at us as we spend our days reading, thinking, talking, reading, thinking, talking, and then doing the hard work of the investing. All of these themes have relevance to what we think about, how we research, what we land in the portfolio, and how we manage risk. I'm not going to go through all of them. John's already covered a few of them. I do want to touch on a couple that overlap with John, and I want to touch on a couple that overlap with how we're investing and what we're doing with the portfolios. So I'll kick off with something I was already touching on earlier, bifurcation. For lack of a better term, I'm just describing to you that our market, it's not unusual for a share market to have a concentration of maybe 10 stocks accounting for 40% of the market. But what is unusual is we have all our big dog stocks adding up to very little achievement over time in earnings delivery. And the outcome of that, so with 40% in what I call the growthless 10, these are the 4 major banks, the 3 major miners, Woolies, Woodside and Telstra, they're collectively not growing, and that therefore burdens the other 60% of the market to deliver any amount of growth for the ASX overall. And partly it makes sense. We're an economy comprised of many of these companies that are big, incumbent, safe, but in their own small sandpit, and so they retreat to yield and dividend, and that's why they don't get a lot of traction in growth. So if you do want growth, and growth's an important part of total shareholder return, you have to fish elsewhere, okay? But let's just now talk about the implications of doing that. The implication is, again, Australia's small, okay? So if I take our tech sector, in the US, the tech sector's 35% of a $60 trillion market. Our market's what, John, 3 trillion? Our tech sector's 4%, okay? So the consequence of a lot of money that observes, oh, I can't get a lot of growth out of the big dogs, I'll start chasing stocks elsewhere that are growing. You get this enormous amount of crowding into scarcity of growth. And I call it growth at any price, or you could call it quality at any price. This table here is just a listing of the first stock is the Australian stock, the next stock is the overseas equivalent. Okay, there's 0, and that's Intuit. This is accounting software. There's REA versus Rightmove. What you'll notice is I've listed PE, EBIT margin and EPS growth. And what I'm demonstrating to you here is if you take an average across these names, what you observe is, firstly, profitability as measured by EBIT margin, not much different, okay? That goes hand in hand with good quality growing tech stocks. The growth as well, this averaged out for the Australian stocks to be about 22% and offshore 17, close enough. They're all growing in the double digits. Just look at the PE though, the rating, what you're paying per unit of earnings is almost 2x in Australia versus overseas. So if I had a CIO hat on and it was all about what growth stocks do you want to have, I would say fish overseas where you can find a lot better value than what you can find here. We don't own any of those names. We have a select number of growth stocks with growth attributes, but we've paid the right price, in my opinion, and we have deliberately underweighted to this sector for this very reason. This is the observation coming through. I'll give you an illustration in just simple terms, and coincidentally, this stock just reported this morning and it's down about 15% as we speak. This is TechnologyOne. They're an enterprise software company. They have just pressed the button, taking a great product in Australia to an offshore setting they've set up in the UK. They produce around about 50 cents of earnings per share, and that's set to double between now and about 2030, according to the way the company's framing their growth outlook and analyst research. Well, what does that all mean? Well, what it means is today, and excuse me, it's now $30, but it was $36 5 minutes ago. It was 71 times PE. How does that compare to history? Well, this is why you've got to care about history. Historically, it was somewhere between 30 and 40 times, and similar sort of growth. What happened? Well, money just decided to say, I need more of this because I can't stand less of that, having more of that. So it got taken into this weird place where it arrived at a very high multiple, leaving it into a very asymmetric payoff profile, okay? And I've got to say, when it does that and you're not there, it's terrible. You're not sleeping, you wonder what you're missing, you've got your fundamental hat on and you can't see a change in the fundamentals. It really messes with you, and that's why there's no hair. But the good news is, if you stay disciplined and you stay in the game, you see the gravity of all this start to shine through when the fundamentals don't quite play out as expected. And today they've just had a tiny miss and the stock's getting clubbed. To frame the upside downside very quickly, let's just assume it's 2030 now and it's still $36 and they've delivered the dollar per share in earnings that they had anticipated. So they doubled their earnings, not bad going. Well, it would have settled down at today's share price to 35 times where it's always been. You made no money. Alternatively, let's just assume you're going to get a 10% return. That's kind of what you'd expect from something like this. A 10% return's a satisfactory return. If that was to happen, the stock would have to go from $36 to $52 with a doubling of earnings, but you arrive at, just the coincidence of the math is, $52 on $1 a share, that's 50 times PE. that's still offensive. So I've always found it challenging. When you're framing upside downside, you have to be always visualising just, we've got some live action on our, on the goings on in the office. So that I hope makes some sense. We're not there. It's coming from liquidity. I'm conscious of time. I want to touch on the energy transition for a moment. This is a total change of subject now, okay? Another theme though, and it's relevant because there's so much spending going on. And why wouldn't you take interest in opportunities to invest when there's a huge amount of investment underway? The problem is, it's all very well for there to be a lot of value being created, but you've got to get close to what companies can capture. Okay, value capture is the name of the game. John summarised it beautifully. Make no mistake, and I'm not going to get into the politics of it, but we are in a most inflationary journey as it relates to the energy transition. It should make complete sense to you. When you spend lots of money, a return of some sort needs to be earned on that. Therefore, you end up with a lot of inflation in the process. On the left-hand side here, this is a picture of our national electricity market. The dark blue is the coal, okay? And as we know, for over 20 years now, we've been slowly grinding that number down with closures. Your lawn was a huge one. We've got more on the way. The good news is we're getting the decarbonisation on this dark blue line in the process, but the other side is it's proving inflationary. Costs are going up, okay? And unfortunately, it's not going to stop because we've still got a lot of wood to chop here to get to a much lower state of thermal. And because we don't have nuclear as low emission base load, we are going to have to overbuild this system with more than what we need so that when the wind stops blowing somewhere, it's at least blowing elsewhere, or we've got firming batteries to back it up, and they're extremely expensive. So we're on this journey, and we just spend all our time asking, well, okay, what names on the ASX are getting involved in this and can actually make a buck for a shareholder in the process? I won't trash talk this one too much. I'll just say that we've done a fair bit of work on AGL. I've followed it for a long time. They are doing all the right things, social licence-wise, investing-wise. It's just, again, as I said, as they get out of thermal and close Loy Yang and Bayswater in the years ahead and redeploy all that money into a large renewable fleet, the question is, what's in it for you as a shareholder? And our observation is, notwithstanding all the money they're spending, the returns on offer are quite anemic. So it is unfortunately a place we've turned over rocks and we're yet to find opportunities for our investors. I'm changing topics again now. Another theme, fiscal dominance. This is what John was talking about earlier. The world's biggest economy has a major problem with its indebtedness, and there's no end in sight. And the natural response to that is the more problematic this becomes, the more it most likely takes us into a new chapter of independence of central banks breaking down. So you think of what previously was a chapter of an ability of a central bank to act independently. They are coming under pressure because the government needs to control the price of money, okay? Not just focus on inflation, but it needs to control the price of money. Otherwise, it can't control the interest costs that are growing as it persists with budget deficits. What happens when money gets cheapened? When you cheapen fiat money, the obvious thing happens. Scarcer forms of money go up in value. That's what gold is, okay? There's 240,000 tonnes of above ground supply of gold in the world. That can't change anytime soon. The good news is we are attached to this theme because we have Newmont in our flagship fund at just under 5% of the portfolio. It's doubled this year, but it's justified because it's been participating with this backdrop of structural support for alternative money that is being cheapened by the US government. This is AI, and we did a video. Please watch the video on our YouTube channel. We went to a lot of trouble to describe the environment. I'll just make a couple of quick comments. I mentioned earlier the Mag 7. The Mag 7 is, roughly, I think it's roughly $20 odd trillion of market cap in an S&P 500 market cap of 60. It has represented about half of the change in the market cap over this last 8-year period, but it's all been validated by excellent earnings delivery. They're all growing because they're all on a global stage. What's changing though, and why you have to think and be a bit wary of this, and you would have seen much press coverage about this of late, there's a change underway where what we once celebrated as growth with little capital intensity is turning into growth with high capital intensity. Okay, so free cash flow is being obliterated by a change from what was just, if you like, a database called internet search to now generative intelligence that starts from scratch and requires a lot of energy and a lot of resources. And so all these companies have no choice. If you want to stay relevant and keep in front of competitors, you've got to be participating in all this investment. The worry or the risk that we face is just what sort of monetisation is attached to this significant amount of spending. What about Australia? Again, I'm sorry to throw a wet rag over this, but as we turn over rocks again and get involved in the investing of the Australian share market, across the three layers of AI described as either chip makers, data centre operators, or companies that can use AI to better how they either serve up a value proposition, user experience, or make themselves more efficient, we have a very narrow and limited opportunity set here. Okay, and not only that, for those that are involved, you have to be wary because the scarcity can push them into prices that just don't make sense. So Australia, we've got one position on in real estate, and we have a couple of names, but I wouldn't even describe them as AI names. I'm just making known to you the scope is relatively limited when it comes to AI opportunities. The last thing I'll say is, I hope nothing unprofessional comes across the... just to let you know, I mean, be aware, the way the market's voting so far is simply chip makers, direct beneficiaries, that's a way to play it, and they've been rewarded. Data center players second, and then as it relates to the software companies, it's really mixed, and it's not clear to us at all that you should presuppose AI as helpful tools is going to allow companies to prosper. It could be disruptive and threaten these companies. Some companies overseas, for example, REA's, I showed the slide earlier, REA's competitor Rightmove, which is the same business as REA in the UK, fell about 20% last week. And that's with AI coming up in the conversation. Normally it's, if you put AI in the conversation, your stock goes this way. So there's a lot of cross currents and a lot of volatility going on. Which is a great segue into this chart. This is overlapping with what Leo talked about earlier. I've been in this industry for 20 years. 20 years ago, I remember starting out in funds management, and if you had a result and a stock moved 5%, that was big. That was a big day, a big movement, and it was pretty much proportional to what revision would happen to the earnings. That's all changed. We don't live in that world anymore. We live in a very, very violent world for shares, which is seeing an increasing propensity for stocks when results are released to move more than 10% either up or down. And that's what this chart's trying to show. Just focus on the rising trend effectively. That's measuring the frequency with which stocks are either rising or falling more than 10% on the day of a result. So T&E's out today. T&E tomorrow will get earnings revisions of a couple of percent, but the stock's down 13% as we speak. So welcome to volatility. I'll talk about how we deal with it. It's a really big issue. Where's it coming from? The rise of passive that Leo was very well articulated earlier. How might we also demonstrate how much sentiment and this volatility going on and liquidity dominates fundamentals? It's very humbling and it's very intimidating, but it's also opportunity. Here's just a few examples. There's two bookends here. There's companies that can deliver earnings growth and get rating on top, and they are rockets. They go to the moon. Eagers Automotive was a name. Now, arguably their PE 12 months ago was too low, but they have progressed their earnings forward about 30% over 12 months, but the rating increase has been 130%. That's dominated the total 160-odd% increase in their share price in the 12 months past. All common to these names is just the backdrop of they've all had an amount of earnings increase, but the ratings increase has been far more significant. Okay? It goes the other way. You can be on, and by the way, I should say, our Rolton Concentrated Equities flagship fund has this name. Very fortunately, we've had a quality name like this in the portfolio, and it's doubled in the last 12 months. It's been fantastic. It goes the other way though. Okay? You can have common thread here, earnings are down, that's the green columns there. Everyone's had an earnings miss, but you lay on top of that a D rating, and now the stock's down 60, 70 odd %. Okay, so this is not what used to happen. I've not put any cyclicals in here because cyclicals don't behave like this. If earnings go down for BlueScope, the multiple goes up because we model to mid-cycle. These get treated very differently. The point is, I'm just saying volatility is here in spades and it shapes how you have to invest. So I'll just go to a summary and then we'll go into the portfolios. Much as we have had a correction this month, the market's down 3% this month as we speak. I don't like running commentaries, but it is a bit of a pullback that was a bit unexpected, but we still remain in, as John was describing earlier with the rate backdrop, we're getting a shallow cutting cycle. Bonds are at 4.4. We're at 18 times. That's still elevated. It's on the high side of history. The yield of our market's below the risk-free rate. So I continue to say what I said last year, 2026, if it's going to be a good year, needs to be about earnings improvement. Concentration of return from banks is a concern. It wasn't as significant this year, but it still played a disproportionate role relative to the size of the banks in the ASX. And then finally, and this will lead into how we're investing and what we're doing, volatility is on display. It's bigger than ever, and it's both opportunity and threat. What it says to me you need to do is at all times be diversified, be selective, as I showed you with TechnologyOne. Good companies don't always make good investments, and patience. Last time in May, I did a different sort of slide, and I'll goof this up. This is just my attempt to try to simplify as best as possible what it is we do. And I'm on the board of a charitable fund and run a 20-stock portfolio for a Victorian-based charity. It's a non-for-profit philanthropic trust, and we have two other trustees that don't invest. They don't know their way around, and they ask me just the best questions because you're always asking yourself, why do we own what we own and why do we don't own what we don't own? And I got clean bowled one meeting a little while ago when a simple question came my way, and it obliged me to spend the rest of the next 2 weeks walking around the block with my dog trying to get the right analogy in mind just to help these people understand what do we do, why do we do it, and how do we do it. So there's just two sort of things that happen with the creation of the portfolios. There's the grunt work of the stock work, the stock selection, and then there's the need to have a portfolio that you build and you manage. This is simply three components. What we do, by the way, how we do our research is what I call one language, involving all companies get put through a lens of shareholder value creation analysis. I mentioned AGL earlier. That was shareholder value creation analysis to uncover whether we thought they could earn a satisfactory return on building out renewables, okay? When we look at Goodman Group data centres, we do the same exercise. Everyone gets treated the same, and the way we simply set it up is we run a traffic light score across assets, strategy, operating environment, management and board, earnings quality and balance sheet. Everyone gets scored equally, and that then has reference into how we're thinking about whether we're dealing with a business that's got above average attributes or below average attributes. We then look at earnings. We need to understand not just whether it's a good business, but what's reflected in expectations, like I showed you with T&E earlier. And then finally, relative value. I call it relative because I find absolute value very hard. Equities are the last to get paid. It's very hard to value things. Imagine trying to value Domino's Pizza when it was $160 and now it's $20. And they're still making pizza. Valuations just follow share prices. So please be very careful about seeing published valuations. It is very hard to value things. It is far better to describe value in relative terms. So I'll talk about Telix in a moment as a great example of that. On to portfolio construction. This is where I'll really fall over. Just visualise trying to make a great veggie patch, okay, where you go to this place called the ASX Plant Nursery. You've got a budget. You can buy 30 plants. What's the name of the game? You want to buy a selection of plants that can generate an amount of income, so fruiting every season reliably. That you know, you're buying like a Telstra or you're buying a Transurban or an ANZ. They're regular, reliable producers. They're resilient. They can deal with frosts and droughts and all that. But because they don't grow much, okay, they stand for safety and reliability and income. But you also need to complement that with some other plants that you buy. I'm not talking seedlings and that's no profit businesses. We're talking about the olive trees, or what would it be, Dave? Something that's got an ability like your veggie patch that can grow. Okay, so putting plants in that can grow and generate a lot more income in the years ahead. You complement those two things. And the last thing to say is every plant's got its role to play in building resilience, satisfying your income and growth needs, but price matters, okay? You don't just turn up and I want to buy this really nice, established, shiny thing over here that's fruiting. You might pay too much for that. That's CBA. Equally, you've got to be careful about buying the down and outs because you might plant it and it just wilts in the summer sun. So that is the name of the game. That's what we're trying to do. I'm going to skip over this because I want to just keep moving into two portfolios. The two big ones, there's Clime Capital, okay? So I'm just going to give it a quick plug. This is our listed investment company. You'll be familiar with this. Why I want to just call it out at the moment, when we talked earlier about a lack of income, the yield of the market's 3.3%. Passive has grown, ETFs have grown. Well, what else has happened? Listed investment companies have lost favour. They've been derated and they trade at material discounts. And this isn't just CAM. AFIC is a $10 billion listed investment company run by a team of 12. They are running an MER of about 0.2%. So they're Vanguard competitive, but they traded a 10% discount to NTA because money has moved elsewhere. I turn that all around and just say that invites opportunity. That's where you've got an amount of yield you can access that's unavailable from these ETFs. So we're currently printing at 60, are we 68 today, John? I can't remember. We're printing about 8% yield at the moment on 50% franking. That's the composition of the portfolio. I'll keep moving, but as I see it, LICs generally, and this Friday when I present to the trustee board of the charitable fund I'm on the board of, and I should just say, by the way, I do 4 meetings a year. It's my weekend job. Don't worry, I do this all the time for CAM and Clime, but we're going to actually make a recommendation to get into a listed investment company because of what's happened. This is the flagship fund. This is Clime Concentrated Equities. I just wanted to publish as of the 14th, how have we gone, what's happening? As I mentioned, it's been a pretty soft year. As of the calendar year to 14 November, we've fortunately produced a return just modestly ahead of the index. But what I want to remind you of is because we stand for value, because we're defensive, because capital preservation matters, what's very evident is we're serving it up on a lower risk basis, okay? We're lower volatility. That's what I want to do. It's hard to get your money back if you lose, so you've got to protect capital. And you'll see that in the portfolio now. We've got currently, as we speak, 9% cash, and we have that as dry powder to opportunistically step on opportunities when they rear their head from time to time. This is the simple makeup of the concentrated equities fund. It's 26 stocks. I bluntly split them into income and growth, and just so I've got a categorisation in my head to be clear, the tomatoes and potatoes and the avocados and the olives. We're currently printing a PE just below the market, but we are printing forecast growth in earnings of about 9% versus the ASX, which actually has recently picked up slightly to 5%. I'm happy to take questions on those stocks at the end. I'm going to run through 4 stocks now, and then I'll finish. I'll just note to you, when I mentioned earlier the need to be diversified and selective, that's reflected in the simple sector composition differences between our portfolio and the ASX. In a nutshell, banks being so fully priced has us invested at a much lower percentage than the ASX. That adds diversity to start with, and it keeps us able to defend ourselves should the rating of the banks come under pressure, which I expect they will. The other to call out is just resources, where here we've got 17%, and by the way, nearly 5% of that is Newmont and gold. The major disconnect there is we only have one of the iron ore miners, which I'll talk about now. The other two we don't have, and the reason, John touched on it, it's not getting much attention yet, but the end of blast furnace steel growth from China as the biggest consumer of steel, combined with the commissioning of Simandou, a major low-cost iron ore supply injection coming from Rio, is going to be problematic for the iron ore price, before even mentioning the rise of scrap and EAF production as China's economy continues to mature. So we are underweight there and we've allocated elsewhere. Our choice in resources is BHP. And the reason for that is when it comes to value creation, don't underestimate how important an incremental dollar of capital is, because it's so illustrative of what in years ahead your capital will be invested in. And BHP, I think smartly, has chosen to get involved in copper. So if we had an energy transition play, this is the stock. Of interest is the way that over the years, BHP's earnings, predominantly iron ore, is gradually shifting more and more towards copper. And that will increase because, as you can see here, their capital spending plans are all skewed towards copper. And I would just note to you, and this is a bit of a pie in the sky thought, but because of the scarcity and privilege of copper, think of Chile. We've just, all the oxides, all the capped materials all gone. We're now going sulfide, we're going down. It's costing more. BHP has a tier 1 portfolio of copper assets, so they are attached to what will be more demand and limited supply, pulling up the price of copper. That gets reflected in pure play copper stocks that are all trading at more like 20 times earnings, whereas at the moment, BHP is stuck in sort of an iron ore type multiple. So there's a free swing at a re-rating of earnings as BHP transitions more and more towards a majority of earnings from copper. This is changing gears now. This is a consumer stock we've put in the portfolio relatively recently. As I mentioned before, we want to buy businesses with wealth creation attributes, okay, and at the right price. And what's happened with Breville, which is you'd know the Breville name, you'd be familiar with their kitchen appliances, probably more importantly coffee. What we like about this business simply is they're on a global stage. They are an exceptionally well-run company. Their net cash, Solomon Lew from Premier owns 25% of this business. He's done very well from it. And in recent years, it fascinates me to think about China, which is a market they're focused on. China goes through cycles of love affairs with things. It was not really iron ore, but iron ore went through a phase. You remember BHP in 2005, it went to the moon, and then infant formula came along and A2 went to the moon, and then Treasury Wine got a bid and it went to the moon. Well, the next thing the Chinese are doing is drinking coffee. They're right into it. And in addition to that, the US market is a filtered market, and that's going to espresso. So Breville's a preeminent maker of coffee machines, and they're growing really well. They've been knocked around by tariffs though, because they manufacture in China and they're selling into the US. So there's a bit of a headwind there, but the good news is they've got all these other operations elsewhere that it's a 120 volt, 240 volt difference. The message is they are well progressed on diversifying their manufacturing away from those headwinds with building machines in China for the Americans. And we've just noticed as well lately the stock's been knocked around a bit. It went under $30. So we made a starter position in this one, and it's one we'd look to add to because on a multi-year view, I think it's got a lot of growth ahead of it. Here's another one of the, I'll call it avocado or olives that we've planted. This is a company called Telix Pharmaceuticals. Okay, so one I've watched for a long time. Telix got over its skis around about mid of this year when it went to about a 10 billion market cap. What this company does is manufacture radiopharmaceuticals. So this is nuclear medicine that's getting a lot of traction because of its superiority in the ability to diagnose and treat in the oncology field. So their focus is on the second biggest cancer of all, prostate cancer. Okay, you have an expression of a protein on your prostate which can be measured and is usually indicative of a cancer. Unlike conventional screens and conventional imaging, what this does is just bind a drug with a radioisotope, binds to the protein, okay, and then the isotope is able to be detected via a PET. So they have a fantastic game plan. They've already commercialised one product in one market with one indication, and the game plan is to build that out into multiple products, multiple indications, and multiple geographies over time. So we were disciplined to hold back when it got to 10 bill market cap and $30. It was pricing in too much expectation of prosperity as they move from diagnostic to treatment. It's since halved. We've made, again, a starter position on because we think much of the things that have knocked it around are just timing related issues as they get from single to global. And we're still watching with excitement as we head into 2026. This is my last slide. I'll take a slightly different view to Leo. It's probably not inconsistent with Leo, recognising COVID delivered a permanent impairment to the office market in Australia. We're aware of that. Look at Melbourne, look at our office attendance. But again, the name of the game is, these might be the attributes, but what's reflected in the share price? And so as part of wanting to fill that veggie patch with defensiveness, reliable income, and some optionality, we've had a position on Dexus for around about 9 months now. We've paid the right price. We've not paid more than today's share price. And why we're attracted to this is not because we see a hockey stick change in earnings anytime soon, but what we do observe is limited downside with an amount of opportunity for upside. And the simple way to illustrate that, if you just look at this chart here, this is price to book, okay? And it won't surprise you, the book values of real estate don't move around as much as the share prices. They fluctuate around a lot. Dexus once enjoyed the status of having a notable premium to its book value, and then it went into a horrible place of COVID. We had interest rates rear their head, and we've since had some recovery, and they've basically been left behind. They're still trading at a discount to NTA. As I said, there's no catalyst. There's not going to be one foul swoop announcement and suddenly, but what we do think is the downsides become very limited because, as we know, interest rates have peaked, office property valuations have bottomed, and the evidence of that is we've now got evidence of a rolling over in incentives, vacancy has peaked, and while you wait for a reconnection between the discount and fair value is circa high $8 a share, you're being paid a 5.2% dividend yield in the meantime, which is above all the other listed REITs in the market. I think that's it. I will stop there, maybe hand back to Barra.